it indeed going to trigger growth here? And is it going to pay for itself, which is something that tax cuts in the past have not done?
Right. This bill will probably spur growth a little bit at the beginning, but not nearly enough to pay for itself. And by the end of the decade, as we look out, the incentive effects, the positive incentive effects that come from some of the reductions in tax rates will start to be offset more and more by the accumulation of government debt beyond what would happen under current law. That extra accumulation of debt will be a drag on the economy, working against the stimulus that might come from the lower tax rates. So I think the effects on growth are likely to be quite muted. And the bill would not begin to pay for itself. I mean, the Republicans' budget resolution allows for $1.5 trillion of net tax cut. And that's at least what would happen under this bill, I think.
Let's get a little academic for a minute here. You've been looking at this issue of taxes for a long time. Famously, you and Martin Feldstein did research together that looked at the 1981 tax cut that showed it did not create job growth. What does an effective tax cut look like?
So tax cuts can spur growth in two different ways. They can just increase the demand for goods and services by putting more cash in consumers' hands, or they can spur growth by lowering tax rates and reducing distortions, improving incentives for households members to work, for businesses to invest, for households to save, and so on. And those two factors can both be at work, or neither could be at work. So over the next few years, this tax cut can help to spur growth a little bit by increasing demand for business investment and consumer spending. But the scope for that is limited by an unemployment rate that's already down to almost 4%. Over time, the tax cut can spur growth by increasing incentives to work and to save. But the limitation on that effect is just how much is this tax cut changing incentives and how much do those incentives change behavior. And we have evidence about how much changes in taxes change behavior from a lot of economists over a lot of years. And that body of evidence suggests that this kind of tax change in both the House and the Senate bills would not have a very large effect on overall economic growth.
And what about on the corporate side specifically? Because as you say, there's been a lot of talk and a lot of debate about whether companies are going to use the savings from these tax cuts to do buybacks and dividends, or whether they're going to spend on hiring and CapEx, for example. And the supporters of the bill have said very strongly they think these companies are going to spend the money on jobs and on CapEx. What does the history tell us?
Well, the history tells us that lower tax rates will encourage somewhat more investment. I don't think it will all be buybacks and dividends. There will be some new investment. But the question is the magnitude. So the logic of the story we hear, which is that lower tax rates encourage investment, the extra investment means more capital stock and thus higher wages. That logic, I think most economists will accept. The question is the magnitudes. And the evidence suggests, to my reading, and I think to the reading of most economists, that those magnitude of that extra investment and the extra effect on wages will ultimately be quite small.